We are a Portuguese-based energy company, working every day to ensure people's lives don't stop. More than 6,000 energy creators are involved throughout the entire value chain, managing a diversified generation portfolio. We are in the Brazilian pre-salt since 1999, participate in natural gas projects in Mozambique, and we are today one of the largest solar operators in the Iberian Peninsula. We guarantee a transformation of excellence, energizing the life of cities, companies, yours. A life enabler in 11 countries. Leaders in electric mobility with over 500 charging points and 1,400 service stations, gas and electricity stores. We develop innovative products, services and solutions with a fresh new outlook on technology, digitalization and sustainable mobility. We believe in transforming society towards a better low-carbon world, of which we want to be part, leading the path to change. We want to be, each and every day, a brand closer to our most valuable asset, people. Because today is a good day to change.
Ladies and gentlemen, welcome to Galp's Virtual Capital Markets Day. Our team is thrilled to have so many of you joining us online. Today's agenda will begin with a strategy presentation by our CEO, Andy Brown, which will demonstrate how Galp plans to thrive through the energy transition. During the presentation, Andy will be joined by our CFO, Felipe Silva, when covering our next 5 years financial plan. We will then have a short 5 minutes break and open up our Q&A session, where the remaining executive members of the board will also participate. At the Q&A, we invite analysts and investors to submit their questions by using the chat tool available on the streaming platform. The questions may be submitted during and after the presentation, and I will read them out in the Q&A session. We have invited all sell-side analysts that cover Galp to participate live in video, and therefore we expect to have some of them joining at that time. We may need to limit the number of questions made during the session to control the total event's time length. Before we start, please note that today's presentation will include forward-looking statements based on the plans, estimates and projections. We refer you to our initial cautionary statement for further information. We will now start the presentation. Andy, the floor is yours.
Thank you, Otello, and good day to all of you, wherever you are. It's a pleasure for me to be able to present Galp's 2021 Capital Markets Day. I've been in the company for 4 months now, and I've got to know the people, the assets, the opportunities and the challenges. And we've undertaken a comprehensive strategic review together with the board of directors. And I'm really pleased to be able to present our plans to you today. What I found in Galp are great assets, great people, great opportunities, a company that can grow and decarbonise and distribute competitively. What I'm going to do, I'm going to discuss some of the conclusions first from the strategy refresh before deep diving into the individual businesses. I'm going to touch on our ESG performance before handing to Philippe to talk about the financial framework. And I'm going to come back and make some concluding remarks. In our strategy refresh, we really challenged ourselves to offer shareholders a resilient investment case against an accelerated energy transition, but also one that offered an upside in the base case. If we look at the next decade, our industry is not going to be static. The pace of energy transition will accelerate. Our markets will change. So it's not just economically appropriate for us to change, it's also the right thing to do. And we're lucky that we have such a strong portfolio. It is resilient with a growing upstream. Actually, coupled with Galp's size, its agility, its innovation, places us really strong for the energy transition. We are already a leading player in the markets we operate in. And we've already started to change. We have a leading position in solar in Iberia. We're a leader in sustainability. We have a very low CO2 emissions in our upstream business. So we have a strong starting point for the energy transition. But our traditional markets in Iberia will decline in oil and gas. But every change is also an opportunity. An opportunity in renewable power generation, in renewable electricity sales, in renewable fuels, in hydrogen, in the battery value chain. So Galp can and will thrive through the energy transition. But we know this is going to require change. And that change will be about our portfolio, but also about our culture. And that's why with the board we've agreed a new purpose in Galp. Let's regenerate the future together. This is a purpose that will be about our portfolio, about our relationships, but also about our people. A portfolio that would shift to lower carbon products, prudently, stepwise, but will have made significant progress by the end of this decade. We want to refresh our relationships with our customers and with society, offering new products to the almost 500,000 people that come to our forecourts every day, or the hundreds of thousands of people we serve at home, to expand our brand, to expand from quality and service to also be innovative and caring. But thirdly, we want to re-energize our people, to develop and acquire new skills to thrive through the energy transition, to bring increased agility to the way we work, to motivate our staff, to allow everyone to achieve their potential. Today, we will cascade our new purpose. It will set a direction for us internally and externally for us to adapt into that future. And for me, regeneration means a new chapter in Galp, one that is refreshed and energetic. Now let's look at the businesses. And how do we think about these businesses and how we allocate capital? We see 4 discrete themes, which kind of reflects our thinking. The cornerstone of our business is still our upstream growth. It's high quality, it's high margin, it's cash generative, and it's low CO2. We also have a downstream transformation business, predominantly in Iberia. This is a business with an opportunity to grow and transform at the same time, moving to lower carbon products. Thirdly, We've got our renewable growth business. We made an important step last year, already in a material position, but we want to expand that in size, in geography, in technologies, and to integrate down the electricity value chain. And fourthly, we have a new segment, our new energies business. This is a business that will be fast moving, low CO2, with complementary skills and assets to what we hold today, and particularly looking at hydrogen and the battery value chain. So we have two growth themes, one transformation theme, and one new business theme. So what does this mean in capital investment? Well, firstly, it will be a disciplined net capital investment of between 0.8 and 1 billion euros per year over the 5 years. 50% of that will be in traditional oil and gas, and 50% will be in low and zero CO2 products. These low carbon products will be fast-growing renewable energy, advanced biofuels, electrical mobility, convenience and other value pools in commercial, but also future opportunities like hydrogen and the battery value chain. Now, our distribution of that capital will be 40% in our upstream growth, 25% in our downstream transformation businesses, 30% in our renewables growth, and about 5% in new energies over the 5 years. We're expecting strong IRRs of more than 20% in our upstream business at a $60 oil price, at between 10 and 20% in our commercial business, and above 15% in industrial and energy management, and on a life cycle basis above 9% in our renewables growth business, and in new energies at least 10% IRRs. Over time, we see our upstream growth business growing in cash flows. But upstream's proportion of the total pie will reduce. And why is that? Because our low CO2 businesses will grow even faster. So this is a strategy of growth and decarbonisation. We want to set clear capital allocation guidelines. Our current leverage is close to around 1 net debt to EBITDA. We want to maintain this level of balance sheet strength. We want to allocate between $0.2 and $1 billion net capex to grow and transform the business, and we may need to rotate some assets to stay in this range. But the quality of our investment portfolios means that we can marry growth and decarbonisation, but using less than 50% of our operational cash flows. We also want to offer a resilient base dividends of 0.50 per share. And when there are additional cash flows and our balance sheet allows, we will distribute dividends up to 1/3 of our operational cash flows. And we'll distribute the base 2 times per year with a variable element after approval at the AGM and with full year results. So this is a unique investment opportunity to reshape the portfolio and to provide a competitive yield. We have growth from our established legacy businesses, our renewables growth business, our new energies business, as well as competitive distributions with upsides. In our base case premise, we can grow our operational cash flows by 35% by 2025, and we can distribute 35% of our current market capitalization in dividends. And for the first time, we are committing to be a net zero CO2 emission company by 2050. So let's look at the individual businesses. Firstly, our upstream growth business. This upstream business is the envy of our industry. We built it up over the last decade, and this decade is a decade of free cash flow and growth. In my career in upstream, I think this portfolio has all you want in an upstream portfolio. The core is the Brazilian pre-salt. Long life, high margin, low decline rates, large resource base with longevity and growth. This is also a resilient portfolio with low unit operating costs and low CO2 intensity. It also has an enviable growth funnel of opportunities that we are ready now to commit to. So it's a portfolio with medium-term growth and a lot of options for the future. So in numbers, we aim to grow our production by 25% by 2025, offering very low production costs, around $3 a barrel of oil equivalent. We have a portfolio with IRRs at $60 of more than 20%. And the operating cash flows from this business over 5 years will deliver more than $6 billion. And we have future growth opportunities beyond 2025. But we must extract value from these opportunities in a disciplined way. So putting this portfolio in graphical context, it is one of the most competitive, attractive, lower CO2 portfolios in the world. The average NPV 10 break-even of our projects is around $25 a barrel. That puts us in the top quartile of all projects. And our CO2 intensity is less than 10 kilograms per barrel oil equivalent. This is half of the IOGP average. So, as you can see, this is truly a leading portfolio. And the jewel in the crown of this is Tupi and Iracema. Almost 80% of our production comes from those fields. They've produced more than 2 billion barrels already, but still just a fraction of the ultimate recovery that we can get from these fields. It is still early days in the full field development of Tupi and Iracema, and there are attractive investment opportunities still to come. And this year we will be submitting and agreeing a plan of development for the fields. And within that, there's possibility for a field lifetime extension. But we have other fields, Ayara in particular with Berbigão, Sururu, Atapu. This is still ramping up this year. In Angola, in Block 14 and 32, we're strongly in harvest and with strong cash flows from those fields. This year, we're going to start up Sepia in Brazil, 180,000 barrel a day FPSO. And next year, we think Coral FLNG will also start up in Area 4 in Mozambique. Since last year and the COVID crisis, we've taken strong capital discipline in our upstream. But still, we have a healthy production outlook from short-term cash engines alone. As I said, we have some significant growth opportunities ready to launch. And this week, you will have seen that we have FID'd the Bacalhau project. This is an amazing project. It's a project which we have a 20% stake in, costing around $8 billion. It's a project, we've actually made good progress already with the 220,000 barrel a day FPSO. It's a project will recover more than 1 billion barrels of recoverable reserves. It is a low CO2 intensity project, around 9 kilograms per barrel oil equivalent, with a break-even price well below $35 a barrel. We expect this project to come online in 2024 and yield a working interest volume for Galp of 40,000 barrels a day. This is really our next step in our upstream growth story and a significant boost to our cash flows from 2025. But our opportunities don't stop there. Coral FLNG is just the tip of the iceberg in Area 4. There are significant gas resources, and we're working with our partners to reduce the cost of the Rovuma development. This is a multi-train development, And we see also potential to improve it further through synergies with Area 1. Of course, we're awaiting the security situation to stabilise before proceeding. But we're confident that the efforts are being made to engage the communities, to improve the security apparatus. And we expect the right conditions to emerge over the coming years. I've been really impressed with Galp's depth and quality of resources, but also the exploration portfolio. The next two frontier wells in Jaca in Sao Tome and Bob in the deep water in Brazil are world class and really want to drill these at the end of this year and perhaps into next. But such is the depth and quality of the resources discovered already that after these two wells and the follow-up, we are going to halt frontier exploration. We believe, because of the lead time to bring those online, that it's prudent to preserve our capital for the low carbon opportunities that are emerging. Now, our downstream transformation. And first, the commercial business. This is a strong business, particularly in Portugal, but also in Spain and some African countries. It's a business that spans oil products, gas, LPG, renewable electricity sales, but spans B2C and B2B. In Portugal, we are a market leader. We have a strong reputation as the flag carrier of Portugal. And we're known for the quality of our services. The merging of our gas and power and oil products business has allowed us to expand and cross-sell all types of projects, leveraging our digital tools, expanding and strengthening our brand to our loyal customers. And we believe we can expand our offer and our customer experience over time. There are almost 500,000 people that come to our forecourts every day. These are unique touch points with customers where we can sell more than traditional fuels. We're privileged to have such a great network, a network that can provide key convenience to customers, where already our non-fuel receipts exceed our fuel receipts. We are actually the largest coffee seller in Portugal. We want to modernize and expand our offering with a new hub concept, offering new products, new service, including EV charging, up to 10,000 EV chargers by 2025. As a result, we believe we can double our non-fuel contribution to our operating cash flows by 2025. So we're strong today. We have a lot more to offer with relatively minor investments and innovative solutions. But not only can we expand on the forecourt, we can expand in the home as well. We have a strong position in gas, which we can expand, particularly in renewable electricity, both through the grid, but also from solar panels through our new spin-off company, Energia Independente. We have an ability to cross-sell using digital tools. Just to give you an example, in April, we added 10,000 customers. And a lot of those actually through what we call the 3-minute app. You can get it online, but you can also find it in our retail stations. And that app will allow you to switch just in 3 minutes. But also we have an excellent B2B business and a strong market share in gas and oil products. Here also we think we can expand our renewable electricity sales. And we think we can do this profitably. And we think we can more than double our electrical sales by 2025. The foundation of this is a competitive supply portfolio of renewable electricity. And integrating potentially also to our renewable generation position. It's about cross-selling. It's about integrating customer solutions. Innovation and digital tools are going to be key in this journey, where we tailor individual consumer and business solutions. To give you an example in that area, we have a promising new e-mobility application for fleets called Flow. That is also building our capabilities around accessing customers. So EI, Energy Independent, and Flow, a demonstration of Galp's agility, ability to innovate, which has a very short time to market. We will continue to expand those innovative solutions to customers. As a result, we believe that we can grow contribution from commercial up to 400 million operational cash flows by 2025. We think we can do so in a capital-light way, a high-return way, growing the bottom line, despite a shrinking oil product demand. And the cornerstone of this is going to be the non-fuel contribution, expanding from 20 to 40% by 2025. The other half of our downstream transformation business is in industrial and energy management. Within industrial, and particularly in refining, improving resilience is going to be key, but also decarbonising the products that we produce. We want to focus on good, high-return projects with short paybacks. But also, energy management is key here, to taking a full integrated approach across our oil, gas, and renewable electricity value chains. Our decision to close Matosinhos in 2020 has significantly improved the resilience of our refinery position. It's allowed us to focus on the gradual conversion of Sines from a grey to a green energy hub. From 2017 to 2030, we aim to reduce the Scope 1 and 2 CO2 emissions from our refining business by 50%. We're going to do this prudently. We're going to do it stepwise. Decarbonising Sines whilst improving our refinery margin, expanding our proportion of low carbon products. There will be low-hanging fruits in high return efficiency projects, but important additions, particularly in biofuels, but also desulfurization to improve the flexibility of our crude sourcing and to reposition Sines higher up the Iberian refinery league table. At the end of the decade, with hydrogen, we can decarbonise further, but this will also be a platform for new fuels. Sines is in an excellent location with low-cost renewable electricity, fundamental for green hydrogen in the long term. But more of that later. Looking specifically at our projects, firstly, optimization. Optimization in energy and operational efficiency will allow us to reduce our underlying OPEX by 15% to around $1.70 a barrel by 2025. We're going to leverage the digital applications we're already installing to fully harvest the potential of fully digitalizing our refinery. But we're also going to put in a desulfurization project that will desulfurize the 20,000 barrels a day of fuel oil fraction. This will allow us to expand the crude diet. This is a high return project, costing a little less than 300 million euro, but it improves our long-term resilience right into the next decade. But we want to do more than just survive with our refinery. We want to thrive. So we want to expand into biofuels, particularly developing a 270 kiloton HVO renewable fuel business unit. A unit that's aligned to RED II, but also has capability to produce drop-in sustainable aviation fuels. We think this is going to be positioned as one of the most competitive HVO units in the world. Why? Because we can recycle equipment from Matosinhos. We can drive synergies from Sines, particularly surplus hydrogen available there. A project we believe we can deliver for less than 200 million euros. We fully appreciate that securing long-term feedstock is going to be crucial for this project, and we will do that ahead of FID. which we plan to have next year. Moving then to energy management. When we did this full strategy refresh, the recurrent theme in almost every work stream was energy management. Whether it's how do we market associated gas in Brazil, it's about placing the very competitively priced venture LNG volumes we're going to pick up in 2023. How do we optimize our LNG from Nigeria or our gas from Sonatrach? How do we get competitive crude sourcing? What opportunity do we have to trade crude and products, particularly around Seanish, which has a world-scale storage facility around 3 million meters cubed? How do we source competitively feedstocks for the HVO unit? How do we place our renewable energy, electricity, with maximum value, trading off value and risk, looking at merchant and PPA solutions, but also integrating to our own consumption, sourcing electricity competitively for our customers, also for our hydrogen business. There is an enormous opportunity to focus on that integrated margin and risk management, to deliver value through our supply and trading, to offer low carbon and bundled solutions, to drive for different products and services. We're currently reinforcing our energy management team considerably because we really think we can extract more value from Galp's expanding asset and customer base. And we believe we can deliver more than 120 million euros operational cash flow on an annual basis. Moving to renewables growth. We made a really important move last year, a 75% acquisition of ACS. This is a material position. And today, here in Lisbon, the sun is shining. We have a gigawatt of capacity online. The solar capture price in the last weeks have been around 70 euros per megawatt hour. So we're happy with this new business we have. Of course, going forward, we have a much more conservative assumption on the solar capture prices, but we're making really good progress on the energy transition. We want to expand firstly in Iberia and then diversify our geographies, but also the technology, moving to wind and storage, battery storage that is, but also leveraging partnerships. At the same time, being very financially disciplined with project financing and selling down our positions once they are de-risked and leveraging up our own equity returns. But then, through integration of risk management, unlocking the most value from the electrons that we're producing. As I say, today we've got around a gigawatt in operation. We actually have 2.8 gigawatts of deals done with projects under development. 2 gigawatts with ACS in their Zero-E joint venture, and about 800 megawatts outside that joint venture in Spain and Portugal. The development funnel of opportunities we're looking at today is much bigger than that even. But today we're focused mainly on Iberia, but already exploring new geographies, recruiting a strong team with the global capabilities. By 2025, we want to have an operation 4 gigawatts, and then up to 12 gigawatts operating by 2030. Most of that growth in the second half of the decade will be outside Iberia, with a particular focus around the Americas. This is not about bragging about gigawatts. This is about returns and cash flow. As I said before, on a life cycle basis, we want to get more than 9% IRR contribution from our equity in this business. We've taken a more conservative solar capture price in our premises going forward. We think we can leverage up with financing of 60-70%. And as I say, we want to rotate our assets around 50%. This means we keep real discipline with our net capital, but we will retain the energy and asset management for all these assets. We're also building some distinctive capabilities with behind-the-meter battery storage options around hybridization between solar and wind, particularly in Spain. We're taking a varied approach on risk management. In Iberia, we will have a mix of long and short-term PPAs and merchant risk. Outside Iberia, we're more likely to take long-term PPAs early in the process, lowering our merchant risk. On a pro forma basis, we want to deliver in excess of 100 million operational cash flow by 2025 and 250 to 30 million by 2030. This business will be deconsolidated off our balance sheet. So this will take the form of cash injection or dividends. We hope to be free cash flow positive, in other words, receiving dividends in the second half of the decade, contributing income to Galp's bottom line, but still growing at the same time. This will become a rateable long-term cash flow with, I think, increased options for value capture around energy management and storage all the time. Moving then to our new energies business. In addition to our end-to-end renewable energy business, we have other exciting opportunities, particularly in new energies, where there are value pools with adjacent to our assets or transferable skills, where Galp's innovation capabilities will come into play, but more industrial in scale than what we were doing in commercial. Two focus areas in new business development for us today is hydrogen and the battery value chain. We believe this can be really important for Galp in the future, but also aligns to what Portugal and Europe is really focusing on at the moment. Now, we talk about around 5% capital in 5 years. This may be more in a success case. But in the second half of the decade, we do believe we will be ramping up more capital investment in these businesses. Let's look at those businesses. Firstly, green hydrogen. We believe we have everything that's needed for success in this business. Low-cost renewable energy, cost-effective execution with a skilled workforce, an ability to build at scale and to come down the cost curve, but also a conducive regulatory environment. Sines in South Portugal has all of these and allows us to move Sines over time from a grey to a green energy park. It does this by offsetting the cost of gas, the CO2 costs, but also utilising the RED II directive. So this decade, we hope to replace all of our grey hydrogen with green hydrogen. That's about 600 megawatts of electrolysis capacity, 60 kilotons of hydrogen. And we aim to have the first 100 megawatts already in the first half of this decade. Because we're building in scale, we think that's just a start. Because Sines is one of the most competitive places in Europe for green hydrogen, we see other opportunities, like spiking hydrogen into the gas network, distributing to heavy-duty vehicles through our retail positions, but also new opportunities for e-fuels or other green applications such as ammonia or industrial applications, particularly in hard-to-abate sectors of the global industry. In addition, we believe there's an opportunity in the battery value chain. The growth of battery demand, particularly because of the growth of EVs, is going to be more than tenfold in Europe by 2030. Securing a European battery value chain becomes actually a point of energy security in the European Union. An end-to-end battery value chain that with green credentials has a particularly important place in the thinking of the European Union. Portugal is really well placed. Portugal and Northeast Iberia boast some of the best lithium geology in Europe. And Galp is already in discussions for an offtake of the raw materials from a mine here in Portugal. But our focus isn't mining. Our focus is going to be lithium processing. And today, in the whole of Europe, there are no lithium hydroxide processing facilities. In a continent that looks to need 400 kilotons of what's called lithium carbonate equivalent demand by the end of the decade. Portugal, I say, really well placed. It has the geology, it has the deep sea ports, it has the competitive and skilled workforce, but also the cost-effective renewable energy. And Galp, as a company, has transferable skills. But we're also building partnerships, and we're in advanced discussions with a leading EU battery manufacturer, considering a first lithium processing facility of at least 25 kilotons. Both the hydrogen and the battery value chain is in business development, but with the right condition, this could be fast moving. This is, say, 5% of capital allocation in the first 5 years, but gaining weight in the second half of the decade. Those were the 4 themes. Now to our decarbonisation path. And if we look, Galp has a strong ESG performance, a strong track record. We think our business plans strengthen our ESG position, and we have an ambition to remain a leader in ESG. We've embraced transparent reporting on environmental and social issues. We have an active board who has the desire to lead Galp through the energy transition. We've already been acknowledged in ESG by the Dow Jones Sustainable Index to be the leader in our oil and gas sector in Europe. We aim to retain this lead. And in this regard, we're going to increase the number of decarbonisation parameters we were going to disclose, but also the pace in which we plan to decarbonise. Last year, we committed to a carbon intensity index of the products we sell to reduce by 15% by 2030. We're increasing that now to 20%. But in this update, we have 2 more parameters. Firstly is our Scope 1 and 2 CO2 emissions. The CO2 we're emitting in our operations from 2017 to 2030, we're going to reduce that by 40%. Now, admittedly, the Matosinhos closure was a big step forward, but we are going to also decarbonise Sines. But we're also introducing a new parameter, and that's about the CO2 intensity of the energy we produce, whether it's, this is Scope 1, 2, and 3, whether it's an upstream or renewable energy. And by 2030, we want to have reduced that by 40%. We introduced this because this is where we're spending most of our money. We also, in this update, have moved from saying that we're going to move in line with Europe on getting to net zero by 2050 by unequivocally saying that we're fully committed to be net zero by 2050. And as you can see, by 2030, we will be already making good progress. I'll hand over now to Felipe, who will talk about the financial framework.
Thank you, Andy. Let's then see how this refreshed strategy translates into our 2021-25 numbers. First, for reporting purposes, we are not changing the 4 business segments you guys already know. We have only renamed Refining and Midstream to Industrial and Energy Management. Now, this new name serves to highlight we want to broaden the scope and to decarbonize our industrial activities beyond traditional refining. We also want to highlight the bigger role we want energy management to play going forward. Cash generation at group level. Our key guidance is based on operating cash flow, so OCF. That's our measure of clean CFFO without working capital variations, inventory effects, and special items. And as most of renewables will be deconsolidated, we add here their pro forma OCF contribution as if renewables were consolidated, and that's proportionate to our equity stakes. Now this year, group OCF should be over 1.7 billion, with refining and commercial still recovering from a rather difficult Q1. Group OCF should increase to over 2.3 billion in 2025, and that's using our base case macro deck, which includes Brent at $60. Now be mindful that this growth in OCF is relatively back-ended, so with Bacalhau operating at close to full capacity in 2025. So we are not factoring in a lot of OCF growth over the next couple of years, other than the growth we see coming from the gradual transformation of our downstream businesses. For 2021, we have revised up our EBITDA guidance to over 2 billion, and this should be over 3 billion by 2025. CapEx guidance for this year, it remains unchanged at 500 million to 700 million, and that is net of the recent GG&D divestments. Now the plan has an average of 800 to 1 billion in net CapEx per year. This represents a 20% reduction versus the previous plan, and mainly from project realignments and cash preservation measures. Now, most of this CapEx is underway with a very good line of sight, I would say, such as Bacalhau and the existing solar pipeline in Iberia, plus the recurring investments into P and commercial. We will continue to keep our CapEx discipline. What is different in this plan is also that around 50% of net CapEx will be allocated to low to no carbon, such as renewables, biofuels, convenience, hydrogen, and the battery value chain. For renewables, we assume that we project finance off balance sheet at around the time of COD, so commercial operation date. And we monetize half of what we have just developed very soon thereafter. So we want to keep this business as reasonably asset light. Now, if I zoom in on upstream, we have over 6 billion in OCF during the plan period. Until 2024, OCF should be stable within 1.1, 1.3 billion, and this will increase to over 1.4 billion in 2025 with Bacalhau. EBITDA follows a very similar trend, rather stable until 2024, 1.7, 1.8 billion, and then increasing to over 2 billion from 2025 onwards. Now, we saw on the previous slide that upstream had some 40% of group CapEx. This will have to be supported by potential portfolio management to control overall investment levels in the group and to keep the balance sheet strong. And given the current uncertainty around Rovuma LNG, we are not including much CapEx for the onshore project within the planned period. Coral FLNG is on track, so that's obviously included in our plans. Commercial activities are picking up really nicely now, but after the slow Q1, we keep a prudent OCF of about 300 million for the full year 2021. OCF should gradually rise to 400 million or so, and EBITDA to 450 million by 2025. So, and for the entire 5-year period, we have over 1.6 billion in cumulative OCF in commercial, and that's across all products and all geographies. Now, diversifying the commercial offer is obviously important to offset declining hydrocarbon demand. By 2025, 40% of commercial OCF should come from C-stores, convenience, gas and power sales, electric mobility, and decentralized solar, for example. So this should continue to be a high multiple business. And for that, we have allocated 500 to 600 million in commercial CapEx during the year. On industrial and energy management, the plan is as Andy said very clearly, to improve resilience and to decarbonize. So for now, OCF will be largely driven by refining margins, which currently are relatively weak. Hopefully this will improve soon as jet fuel demand normalizes. In 2021, we also have the one-off costs related to the access to the regasification terminal in Portugal. So for this year, 2021, OCF from industrial and energy management is expected to be only 100 to 150 million, and EBITDA lower than that, about 100 million, as it does not include the associates contribution from our stakes in the gas pipelines, which will expire anyways this year. Cogeneration, logistics, and other non-refining industrial businesses should bring in some 25 to 30 million per year in EBITDA, and HVO will add another 50 million or so to EBITDA once it starts up before 2025. Overall, industrial and energy management OCF should be over 350 million by 2025, with energy management contributing with over 120. The majority of CapEx will be directed to transformation, HVO, desulfurization. These are investments which are adjacent to our very core operations, so it reinforces the competitiveness and the decarbonization of the overall Sines complex. On an accumulated basis, we have some 1.2 billion in OCF during the period and some 700 million in CapEx. Now, the CapEx bar on the right-hand side is already net of the recent divestment in G&D. On renewables, the plan is to keep this business fully deconsolidated with its own capital structure and project financed. And our pipeline is gradually built. By 2025, pro forma OCF should be about 100 million. This assumes we have about 50% of the equity on the over 4 gigas we expect to have operating by 2025. Our share of the projects should generate over 300 million in OCF during the planned periods. But this, however, becomes very meaningfully higher from 2026 onwards. Renewables CapEx should total some 1.2 billion during the 5-year plan, and that's already net of asset rotation. So the plan is to keep and fund 100% of the projects during the develop and build phases, project finance at about the time of COD, and then rotate half of our equity very soon thereafter. So this supports our overall CapEx plan and leverages the returns of renewables. New energies, green hydrogen, the battery value chain, this should make up, I would say, about 5% of group net CapEx. This is ballpark. It will depend on how quickly these projects get off the ground. And most likely, we will have partners in some of these projects, and we'll be raising finance also at the asset level. So we expect OCF from new businesses to be positive in 2025. Now, the OCF bar here doesn't show new businesses OCF, as 2025 positive OCF is actually eaten up by negative flows during the initial years. Now, putting it all together, we have about 9 billion in OCF over the 5 years. And here OCF is as we report. So not with a pro rata OCF from the deconsolidated business. This is just with the dividends that we actually receive from, say, renewables, after renewables has services its own project finance debt. So where are the 9 billion going to? About 45% is going to CapEx. About 1/3 is going to dividends to the Galp shareholders. And that's the base dividend and the variable component. About 10% to minorities, and the rest for finance costs, and there's a little bit of deleveraging in the plan as well. And because we have much lower sustained capex than our peers, given the youth and the long life nature of our upstream portfolio, we have room to grow our business and decarbonize significantly faster. On the dividends, now we should be already under 1x net debt to EBITDA this year, so which would support the variable component of the dividends. And the way this will work is as follows. The base dividend of 50 cents is paid semi-annually. Say half is distributed this fall and half is paid in May after the AGM. And that is when the variable component is added as well. I will stop here, just highlighting that the plan has free cash flow covering 1.2 times total distributions. So the quality of the dividend policy is quite robust, we think. Andy, back to you.
Thank you, Felipe, for that impressive deep dive into the financials. I'd like to make some concluding remarks before we go to the Q&A. I hope you've seen that we can thrive through the energy transition. We can and will accelerate the decarbonisation of our portfolio. We will grow in a resilient and value-driven way, whilst maintaining a robust financial position. But we will also offer competitive shareholder returns. Can I illustrate and compare with our peers? We're offering leading cash flow growth of 35% of operational cash flows to 2025, a strong pace of decarbonisation versus our peers. We're growing in a capital disciplined way, with only 45% of our operational cash flows put into that growth. And we're offering a third of our CFFO in dividends. This is truly distinctive. We're going to work with the board with the support of my ExCom colleagues, and we are committed to take on this challenge. So let's regenerate the future together. Thank you.
Thank you, Andy. Thank you, Felipe. So this concludes the presentation. I hope it was an insightful one for you. We will invite you to watch a small video now, and we will come back in 5 minutes. See you in a short while.
How are we going to reshape our portfolio towards a lower carbon world? Leading profitability and carbon intensity upstream growth. Improving our industrial resilience and reducing carbon footprint. Unlocking value from a commercial transformation. Expanding our renewables footprint. Developing new energies with scaling up potential. Reinforcing our decarbonisation path towards becoming net zero emissions in 2050. We will thrive through the energy transition, delivering superior growth from a low capital intensive plan and driving to a superior distribution. Let's regenerate the future together.
Welcome back, and firstly, thank you so much for listening to our presentation. We now have the Q&A, and hopefully we can answer all your questions and explain our plans further. Before that, I have got some support for some colleagues from the ExCom. I want to just introduce them. Firstly, I think a lot of you know Otello. He's going to be our Master of Ceremonies. He's in charge of IR. We've got Felipe, who is my CFO. He keeps me on the straight and narrow. We have Carlos Costapina. He's our CEO Corporate. He will answer questions around sustainability. We've got Susanna. She's in charge of renewables and new business development. We've got Torre. He's responsible for our upstream growth business. We've got Sophia. She's responsible for our commercial business. And we've got Carlos Silva, who is responsible for our industrial and energy management business. So I have the whole team here ready to answer your questions. And I'm going to hand to Otello to actually introduce all those questions for us to answer. Otello.
Thank you, Andy. Before we jump into Q&A, a couple of organizational questions. So we will be having sell-side analysts connected through video, and we will also read some questions made through the chat platform. Because we already have a lot of participants, we will need to limit some of the questions. Please, for the video participants, we will limit your questions to 2 per each. Okay? We will try to limit the Q&A up to 90 minutes. And I'm told that I already have the first in line for the questions. Joshua Stone for Barclays Capital. Joshua, good to see you. The floor is yours.
Hello. Yeah, thank you, and good afternoon. Thanks for the presentation.
Hi, Joshua.
2 questions, please. Firstly, you defined a base dividend level at 0.50. Can you talk about why is that the right level for Galp? Should we consider it as sacrosanct regardless of the environment, or is it defined by a particular oil price? And then my second question on Brazil. You mentioned recovery rates. Are you able to say where we are today? You previously talked about a long-term ambition of 40%. Is that still the case, or has that now gone down the order of priority? Thank you.
Okay, so thank you very much for that. And firstly, let's talk about the dividends. I've got Felipe to help me here, but I think you got a question about the base. And why do we set the base at 50 and then have a variable component? Well, it was very much for, as you explained, this is a base case, a resilience case. And in our planning, we actually looked, particularly if we have an accelerated transition, and I mentioned that at the start of the presentation, what kind of prices may we get in oil and other parts of our business, and what can we afford as a base dividends? And our conclusion was the 50 cents was resilient through the cycle to keep our balance sheet in shape. And then the variable component is very much related to if we got a macro more like the base case, that would start to pay up. Do you want to add anything to that, Philippe?
Josh, so the 50 cents is designed to withstand macro events, and we all learned our lesson last year, so we want to avoid this. Does 50 cents stand if Brent is below 50, refining margins go down? Yes, it does. The upside, and you see Andy said about 35% of our current market cap could be distributed in the plan. So if you do the math, that would be on average about 20 cents across the period with Brent at 60. So 50 is resilient, there is upside. One of the questions we also get asked a lot, Josh, is buybacks. And what we've kind of tried to provide this solution on having the variable component working a bit like a variable dividend if we have excess cash flows. So that is the logic.
Joshua, then your second question around the recovery factor, particularly of what we now call the 2P field, and what do we think that recovery factor is? That's something that we really leave to Petrobras to reveal to the market as the operator. But to answer your question, no, we haven't changed our view on how much oil we can recover from this field. As I said in my remarks, we are at really just produced a fraction. We're essentially in plateau now, but with a lot of development opportunities still to come. So actually it's kind of premature to really count on those last percentage of recovery. But there is, because we're not announcing that number today, it is not because we've changed our view on the field. But it is contingent on agreeing a plan of development and possibly a field lifetime extension, which will be part of discussions this year. I don't know if, Tori, you want to add any more to that?
I certainly would like. You know, you guys that have followed Galp now for many years know that I think the world about 2P Erythema, it's a world-class by any standard. 6 years ago, Galp launched on its Capital Markets Day the ambition that we should really drive up the recovery on Lula and 2P Erythema. Actually, last year, there was a major breakthrough on this because then we agreed in the partnership that we should sign an MOU where the whole purpose is that we are working this year in order to agree a new plan of operation and development, which we have all the ambition to deliver by the end of this year. This will be a significant step in order to realize that long-term ambitions, which I have to say I'm extremely proud of what the Galp team have contributed and how they have been asserting into the partnership that we should really drive for this. I remind you, 1 percentage point increased recovery on 2P Erythema is nothing less than 200 million barrels. That's a good day at work for any explorationist. Thank you.
Thank you, Tori.
I think we can move on. We will now have Mehdi Enebati from Bank of America. Mehdi, bon après-midi. We are happy to take your question.
Hi, so good afternoon, everyone, and thanks for taking the questions. So 2 questions, please. One follow-up on the dividend that you detailed a little bit. I mean, it seems that you are accepting for your dividend to be quite volatile. Let me give you an example. Imagine the oil price this year will have reached $70 per barrel. So you will have a relatively strong cash flow from operation. And next year we go to $60 per barrel. Then you might have, to lower the dividend in order to respect your new dividend policy. So am I understanding well when you say that your dividend could be quite volatile in the coming years depending on the oil price? And just one very small question on that. You expect 2.3 billion euros of CFFO by, or OCF, let's consider this is roughly the same, by 2025. So if I am understanding well, does that mean something like 92 cents dividend in 2025? Next question regarding your production growth in 2025, okay? So you provided a 25% growth compared to 2021 production. So this gives around 160 kboed guidance in 2025. However, currently your production at plateau is around 140 kboed, excluding the pandemic impact. And Bacalhau will add another 40 kboed at plateau. So that makes your production significantly above your guidance without even including Coral sepia production, which should add another 10 kboed. So my question is very simple. Are you expecting a significant depletion rate from your existing production in Brazil to justify 160 kboed, and why? Or do you already take into account, some delays regarding Bacalhau startup and ramp up due to pandemic situation in Brazil? Thank you.
Thank you very much, Mehdi. And so let's first answer your question around, will this dividend be quite variable? The answer to that is yes, it will be, but it has the resilient 50 cents. And it has an ability, and your calculations are right, that in 2025 it could be up, and it could be more like 90 cents or 9% yield at that point. As Felipe pointed out, on the average, if we look at our plan, it's around 7% over the 5 years. Clearly, if we have a real dip, we will use the balance sheet a little bit to smooth out and allow the debt to go up a little bit, and still pay the 50 cents. So it has a floor, and it has this flexible variable element that is very much aligned with the macro, because we're pretty clear about how much capital we're going to spend, and we've got clear ideas of how much cash our business can generate. So, I think the answer is yes, you are right. It will have that variable. But it means our shareholders are enjoying the business when we're enjoying it. And as Felipe says, it avoids this situation, this boom and bust, that we have to cut the dividend and everyone's disappointed and you don't have any understanding of predictability of where we're going. Now you understand steady base with variable that reflects the macro. I think just leave it on the dividend and move on perhaps then to and I'm going to get asked Tore to contribute here, the numbers. And so we've got Bacalhau, is it 40 in 2025? How do we think about that? 25% increase. Does that mean, our base is declining? Perhaps you can explain a few things around that, Tore.
Thank you. I think it's very important to factor in here that even in 2025, Bacalhau will be in a ramp-up state. We're expecting no delays to the start of our Bacalhau, but as we have guided you to, this is second half 2024. 2025 will be a ramp-up year, and then we have put into and is in our plan that there will be a natural decline from the existing fields. In addition to that, we have put in an element of cautiousness where we have sort of in general assumed on some of the Brazilian assets that we have a somewhat lower production efficiency because we see that the units will require more maintenance. So you can say it might be prudency. We think it is good business practice to put this in, and we're feeling comfortable therefore with the 25% growth target that we have put forward for 2025.
So, I think the base is pretty stable. I think that's the conclusion. And the Bacalhau comes up and is still in ramp up in 2025. That really fundamentally, I think, is the answer to that one. Yeah, thank you for the question, Mehdi.
And the next in line will be Oswald Clint from Bernstein. Oswald, good to see you. Please go ahead.
Thank you very much, everybody. Andy, it's refreshing, I guess, to hear your enthusiasm about the upstream, your developments, and even exploration, certainly in this day and age. But I wanted to ask you around what's a longer term growth rate do you think is possible beyond, or what should be targeted given your accelerated decarbonization targets today, please? And secondly, I wanted to ask around the retail network, the B2B and the cross-selling. This is new, I think. This is a strategy. It wasn't on the agenda before. It certainly felt very Shell-like listening to it. But we know the business through Repsol in Spain. But others like Cepsa, I think, have been less successful trying to replicate them there. So I can see why Galp should be successful. But why is it not done before? Why are you confident? And the 20 to 40% uplift here, is that back-end loaded or is that rateable across the next 5 years? Thank you.
Yeah, thank you very much. Also, we're not disclosing numbers and beyond 2025. You can see that. The exploration, I have to be clear, and I think this is quite an important point. After the 2 wells that I have indicated with follow-ups, we are going to halt our exploration, our frontier exploration program. This is very much, saying we have enough in our resource base to stimulate growth for some time. 2.4 billion barrels of 2P and 2C resources, 50 years at current production rates. So that's a lot of oil and gas currently discovered, which gives us an ability to grow after 2025. Clearly, what happens to Mozambique when that LNG project is brought in line is an important element in that. But we're not guiding on long-term production for very much, the reason you indicate. We're taking a cautious approach today. We're growing our alternative businesses. We have the options in upstream, and we will pursue those when, for instance, the security allows, and when they become very attractive opportunities within our capital discipline. And we talked about our new energies business, a hydrogen business, battery value chain. So we're going to have options for investment after 2025 that today we can't be fully predictable. So it isn't at this stage, I think, appropriate for us to be giving you production numbers beyond 2025 when we really don't understand which are going to be the most attractive investments for Galp and which fits our long-term strategy. So we come to the commercial business, and I think this realization that we can do so much more with customers, I think is one that, yeah, I think it is a new, fresh approach in Galp. It's you know, I brought something, but Sophia, who's only recently joined our executive, also has brought that sort of insight. You know, I think particularly in Portugal, you know, we have such a strong brand. We know we are the market leader. We have the opportunity to offer much more to our customers than we're offering today. And I think, you know, I'm very excited about the opportunity that this gives. We're actually already on the journey. So this isn't just like, let's do that tomorrow. 2020, we actually started to do quite some exciting things. And, you know, we're going to have some of these new hubs online relatively soon. So we're going to lean into this quite quickly. And I'm going to hand over to Sophia to perhaps talk, you know, about a couple of things we're doing and just a touch on how quickly we're going to be able to offer more services and hopefully make more money in the non-fuel space. Sophia.
Thank you, Andy, and thank you, Oswald, for your question. We are super excited to speed up on this transformation. I mean, we believe that we have the right to be on this area. I mean, actually, DC stores represent 60 million of EBITDA today, and we believe that we can double them until 2025. Why? Because we have, and as Andy mentioned before, we have 500,000 of people entering into our stores, customers that are engaged with our strong brands that have been engaged with more digital tools that we are implementing. And on the other side, we can also cross-sell, as you mentioned, to these customers and touch them during their day, not only on our ecosystem of e-mobility, but also in our ecosystem of the home. And as Andy mentioned, we are rethinking, and we just conceived 3 concept stores for the new service hubs around mobility and around lifestyle. With this, we are going to offer products and services totally different around these new trends, these community trends. And you know, the world has been changing, so we are also changing. We believe that with this, we'll be able to go from 20% of low carbon contribution into 40 in 2025, and it's true that it's something that it's new and it's something that other companies didn't succeed, but we believe that we have the right to do because we have such a broad portfolio that allows us to really cross-sell and to touch point with the customers on all of these journeys. And on top, we had recently launched new businesses like UI and like Flow that are also being speeding up towards our customers and towards the B2B, and with also these new energies, we'll be able to cross-sell and to maximize the value towards our customers.
Yeah, so I mean, and last year, I mean, we started to expand in Uber Eats and Glovo, and we found customers really like ice cream, particularly in the evenings, and so you get this array of products that we're able to offer customers that I think we hadn't really discovered previously, that I think will be very successful for the future.
So,
Tello.
Next time you think of an ice cream, just call us. So now, next guest is Raphaël Dubois. Salut, Raphaël, from Société Générale. Please, we are happy to take your question.
Bonjour à tous. Thank you very much for setting up this event. And you should not be talking about ice cream. I'm starving now. Anyway, 2 questions, please. You show on slide 31 your expectation for 100 million euro of OCF by 2025. Can you please share with us a little bit more your assumptions behind this number? What kind of power prices is embedded? And also, what will be left once project finance debt servicing is achieved? So that's my first question. And the second one is on the offtake agreement that you mentioned in the new energy business for lithium. I think you talked about a mine. Are you referring to the project of Savannah Resources? And if not, can you maybe share with us a bit more information? And what is the plan B if this mine of Savannah Resources is not up and running by 2025?
Okay. Thank you, Rafael. I think it's really important for us to perhaps explain a little bit around the cash flows around our renewable energy business. We have taken a more conservative approach. We have increased the number of PPAs and therefore the risk management of that. And perhaps Philippe can explain how we manage and the debt and how much of the 100 million that we can recover.
Rafa, it's actually quite a simple business. The price at which you sell the electrons drives, CapEx is relatively standardized, certainly in Iberia now. So if you have a solar capture price, which we've now assumed at a deeper discount to baseload prices, pool prices, and you take 35 to 40 euros, and you multiply by 20% yields on your installed capacity, and that's a net of 2 gigas, not 4, so because we're assuming we're rotating out of half of what we have, then you get that sort of number. So fairly straightforward. What is left, so this is a deconsolidated business, so this money in 2025 is still not coming to Galp. We are servicing the debt of the project companies, and we're redeploying excess cash into new projects. So free cash flow positive only a few years after. What we are not factoring in this plan is dividend recaps, and that's a huge upside. So there's very little point in having this great business delevering quickly, not paying dividends. So most likely, given that it's such a low risk business, that you would do a dividend recap and upstream cash into Galp much earlier than we are building up in the plan.
So look, if I can perhaps then just address the whole issue around, we are assuming a declining solar capture price off the pool prices. We are assuming that we're going to take a fair amount of short and long-term PPAs. We've got some merchant exposure as well. This is Iberia. Outside Iberia and the rest of the world, we think we'll take a larger amount of PPAs. But some of these things are clearly, as time goes on, we see opportunities to leverage up returns more than perhaps just even the 9% that we've put into the presentation. And I'm going to ask Susanna to say a little bit about how we might even get some more from this base plan, which I think we've conservatively set. So Susanna?
Thank you, Andy. So, of course, as Andy have mentioned, we have considered a larger share of PPAs in our portfolio. We are planning that by the end of this period, we'll have between 80 and 90% of all our projects under PPA, more outside Europe, of course, than in Iberia. But I think there's a lot of upsides that you can put on top of these returns with PPAs. Of course, you have financing returns, you have asset management fees returns, you have some short-term hedges returns that you can improve the economics of the projects. But I'm also especially excited about, let's say, 4. One of them is because of our integration with the commercial business. We can take some merchant risk that can balance across our business, so we can take some of this upside. And I think for me it's also very important, as Andy already mentioned, the asset management, where we will be able to anticipate some of the value of these projects and rotate the capital for further projects, and that will also increase the overall returns of these projects. But maybe for me, because I'm also into innovation, the 2 that I'm most excited about are storage behind the meter batteries. We are already working on a pilot that we hope to have ready by Q1, where we see a huge upside about being able to balance the production curve and being able to capture the hours of the day with higher electricity prices. And of course, also hybridization with wind. This is an upside everywhere, but especially here in Iberia, where you can get up to higher 50% more capacity on your connection point. And by combining solar and wind, you are able to create a much more base load profile, more profitable for our clients. So this is a very conservative scenario, a lot of upsides, a lot of leverage that we can have in order to increase these IRRs going further.
Thank you, Susanna. Let me now address the whole issue of the battery value chain. And I did mention that we're in discussions with a mine, and you may well have seen a press release where our HOA lapsed at the end of last week. We don't like negotiating via press releases, but we're in discussions with the mine still, so I have to confirm that. But this is a lithium-prone area that spans across North Portugal into Spain in northeast Iberia. So it's an area where we believe there will be more opportunities. But because we're planning on the processing side over time to perhaps take a really big position, we also have to consider opportunities also to import some of the raw materials. So we're looking at all sorts of options, but our focus is on lithium processing. And for that, we're actually working with a leading European battery manufacturer on understanding how we can work together. As I said, there's no lithium processing in Europe. There's going to be an enormous demand, so we see a key opportunity. Obviously, sourcing renewable feedstocks is going to be crucial. Clearly, the mine in Portugal is one that we have been working in. We've done some due diligence, and we need to work with them on how we could work that particular mine. These things have to come together for us to make this whole chain, but Galp really wants to be right in the middle of that chain, working from the sourcing of the spodumene through to the delivery to the cathode manufacturers onto the gigafactories. So it's early days. It's by the week things are moving fast. But I have to say, as a business leader looking at the future of Europe and the future battery demand of Europe and the geology of Portugal and the deep sea ports and the capabilities of Galp, this is a business that I think could be, really very big for Galp for the future and very much aligned with the energy transition.
So I will take the opportunity to read one of the questions that we received in the platform from Jorge Guimarães from JB Capital Markets. Since Galp is not a renewables developer, how do you expect to create value in the development phase in order to farm down with the profit later the 50% you expect to farm down? I assume part will be capturing the margins of electricity supply from cheaper sourcing, but even so, the question remains.
So, Felipe, you're going to say this one?
So we do have very significant capabilities, and you will have noticed our capex into renewables has gone up compared with our previous plan. So we are assuming we will hold on to the projects during the build, develop, de-risk phase, project finance only at that stage, and find partners, whilst before the plan had this monetization much before. So there is significant value to capture in using our skills, our balance sheet, de-risking, PPA, commercial contracts, so that we monetize the premium that comes with higher risk as well. And we have very significant demand by very low risk, very low cost of capital investors that would like to come in at that stage with a much lower cost of capital. So the rotation part of the build, de-risk, and sell down is integral to our business case.
And our next question comes from Biraj Borkhataria from RBC Capital Markets. Biraj, please go ahead.
Thanks for taking my question. Hopefully you can hear me. Two, please. The first one on your decarbonisation targets. The base year is 2017. Could you talk about the impact of the refinery closure on those targets as we're in 2020, 2021? I would have thought that that's quite a significant step, both in an absolute basis and intensity. And the second question is on Bacalhau. At one point earlier on in the process, you were talking about two production units. Is that still being considered at all, or is that completely off the table? Thank you.
I didn't quite hear that.
Can you repeat the second question, Biraj? Sorry.
On Bacalhau?
At Bacalhau, yes. At one point you were considering two production units. earlier on.
Okay.
Is that still being considered at all at some point, or is that off the cards?
Thank you. Hi, Biraj. Good to see you again. Clearly, Matsushina's closure has helped us with the overall Scope 1 and 2 decarbonisation, and also towards the 50% reduction in the refinery CO2 emissions that we have. I think on the refinery, of the 50%, around 27% is actually from the Matsushina, if I'm right. So it's an important part of it, and clearly, refinery closures and the CO2 we save from that. But the rest of that, and if I look at the 50% we're talking at Sines, or the refineries in total, is going to be various decarbonisation projects that we're going to go through low-cost decarbonisation projects, but also then the introduction of hydrogen over time in Sines. So that really are the key elements for us to on a whole Galp basis, to reduce 40% from Scope 1 and 2. And so the second question was related to Bacalhau and the second unit. And so what happened? So we've got the first phase, FID'd yesterday, great news. So, Tore, where's the second unit?
First of all, I have to say that I'm so proud of Galp also in this case, because we are the only original partner in Bacalhau. The others disappeared. Equinor and Exxon came in, that really accelerated it, and yesterday we had then the FID of something that is a world-class product by any standards. And yes, we think there are more. That will happen in the second phase. What we need to do before we decide on that is to do further appraisal work, and based on that appraisal work, we will then decide what will then be the best way of developing the next phase. There are several options. It could be a tieback, it could be a standalone unit, but we need more appraisal. But the big triumph day for the Galp team yesterday, that actually was the only original investor in the Bacalhau field.
Good, thank you, Tore. So more news to come on further development of Bacalhau beyond phase 1.
Okay, next one from Peter Lowe from Redburn. Peter, good to see you. Please go ahead.
The first one was on renewables. Most of your growth post-2025 looks like it will be outside of Iberia, which on the face of it is your natural market, given your existing customer base and brand. Is that because you see competition and returns in Iberia as more challenging versus what is available elsewhere, or what's driving that switch? And then the second question was just a clarification. You talked about portfolio management in upstream to help manage the capex commitments there. Can you just clarify what that means? Are you looking to reduce your stakes in certain projects, or actually are there parts of the portfolio you would consider exiting? Thanks.
So, good. Let me answer the second one first. So, around portfolio management in upstream. Clearly, no company wants to reveal what they may be thinking of selling, but Galp has an enormous upstream portfolio, and I talked about the 2.4 billion of contingent resources. We have a lot of exploration positions, we have pipelines, we have positions on production. What I'm really keen to get a message across is that we are going to manage that portfolio for value. And it doesn't mean we're going to stop all new business development. It means that we're going to keep Tore strictly to his net capital number, and we're going to manage the portfolio, which means selling some things, it means developing some things, but it's too early for us to give you a definitive list of these things that we're firmly planning to sell. On your first question around renewables post-2025 and why leave your home base in Iberia, this is really about risk management, to be honest with you, but also growth of capabilities. Iberia is a competitive market. Iberia is a fantastic market for solar because of the opportunity, how much solar radiation there is, the drive of the Spanish and Portuguese governments to bring more renewables into the portfolio. But as we also mentioned, it is somewhere where, with a lot of solar penetration, you're going to get a disconnection between solar capture prices and pool prices. So in order to manage this as a well-managed risk portfolio, we're looking to expand overseas as well. And we see overseas locations where you get much more attractive long-term PPAs, where we're building a team with some real capabilities of understanding some of those locations. And with an opportunity to move into markets perhaps also earlier in their evolution, where there are some higher returns than we think we may be able to enjoy in Iberia. So risk management, diversification of both, using solar and wind, in order to make sure that we have a well risk managed, high yield portfolio. I don't know, Susanna, do you want to add anything to that?
No, maybe one thing is, yes, we are building a team, but we already have an outstanding team. So over the last year, we have building a team that has been developing thousands of gigas. Thousands of gigas, tens of gigas around 35 countries around the world, have managed assets, gigas of assets also in many countries, have also built these assets. So we have a very robust team already with experience that, as Andy very well said, we are continuing to expand and bring new capabilities into these teams. And I see it not as a risk, I see it as an opportunity. As Andy very well said, this growth is enormous. It's enormous around the world. We have the capability, we have the agility that we have shown in building the team and building the assets. We have the financing power that small players don't have. We have the ability to partner. So I think one of the things I like the most about Galp is what a great partner it is and how easy it is to partner with Galp and the great relationships that it has with its current partners. And we already mentioned the team. So for me, what is important about new geographies, as Andy said, stable market for PPAs, where you can have businesses taking PPAs at much more attractive conditions than we have today in Iberia, countries where we have reasonable country and currency risk and renewable growth, where we have long-term investors that are interested in asset rotation and sticking to those assets in those markets. And as he said, in order to also come into these markets earlier, where we can do greenfield or develop early stage projects in order to maximize the returns for Galp. So it is not that we want to leave our home market, it's that we are ready to grow internationally.
And can I just say, I've come in the CEO of Galp, obviously having had an international career. I find such good, competent people here, and very international people as well. And I think there's a great opportunity for Galp to continue to develop business overseas. As you see, everyone speaks excellent English. That's very lucky for me. And I think they have the potential to expand internationally, and I'm very excited about that.
And Spanish, and we'll continue with the Spanish accent because we will now have Pablo Cuadrado from Kepler Cheuvreux. Pablo, the floor is yours. Happy to take your questions.
Hi, good afternoon, everyone from Madrid. I hope all of you are fine. Two questions, please. The first one is, you can clarify a little bit which is the assumption that you have on the upstream volumes by 2030, basically included in your target of 40% reduction in your carbon intensity production figure when compared to 2017. Particularly, I'm looking, if you are assuming on those figures, Rovuma LNG and the level of production that you are including there. And the second question will be on the announcement on the biofuel HVO investment. I know that the FID is next year, and you are talking about 0.3 million tons capacity, but I was a little bit surprised when you talk about IRRs above 15%, because if we compare to other peers that they have announced investments on HVO biofuel, I think that level of return seems to be a little bit soft. So I was wondering if you can detail a little bit more, the basis of that investment, what type of feedstock that you have in mind. I guess probably something linked to waste. If you can also share, the margin that you expect per ton that you think you can make on, or basically the numbers that you use to get to those 50 million euros EBITDA that I think Felipe mentioned as a potential contribution. And on that front as well, and I finish, is that the first step, this potential FID, but you still see that you can enhance more that business exposure?
Yeah, thank you, Pablo. And let me first say on the 40%. Look, I don't really want this to be an opportunity to try and back calculate to see what our production numbers are. It's a target that we take on today that we mean to adhere to. And if we have more production, we may need more renewable energy. So, I think this is something where I don't want this to be an engineering way to back calculate our production number. You just have to believe that this is something that we're going to be very focused on. And as I say, we've using this 40% production number. A lot of people have been looking at the sales, and yeah, we're going to do that, and 20%. But for me, we spend our money 70%, 30% in renewables, 40% in upstream growth. Gosh, that's where we're spending our money. That's our contribution to the world in terms of new energies or new energy supplies. So that's the number we're focusing on, the 40% reduction. And we have a plan, but that plan will change over time. And as I said before, it is too early for us to give you some definitive numbers post 2025. On the HVO project, I'm going to ask Carlos Silva in a minute to talk a little bit about the sourcing. And as I said before, obviously this HVO unit, what we have to position it is within an Iberian context, and predominantly, of course, Portugal for us and some Spain in terms of how much HVO is going to be needed to meet the RED II directives in each of the countries. So how much space is there for it to achieve the margins we expect to achieve. We also have made the very strong point that we think we've got some tailwinds on the project in terms of cost with the Matosinhos equipment reuse and some spare hydrogen capacity that exists in Sines today. So I'd like Carlos to really focus on then the feedstock sourcing and perhaps also explain that we have some experience already.
Thank you. Pablo, the HVO project is really an opportunity to a value creation project at Sines, New Sines Energy, Green Energy Park. This project will allow us to be aligned with the RED II that is coming on stream, and it will give us the opportunity to assess new value pools on the industrial arena. In regarding to the feedstocks, we have already experience regarding the feedstocks for biofuels. We are already in the international market, so we have some partnerships that we are keep developing, and by that mean we are de-risking the feedstock for our project. As well, we are progressing with the studies in terms of engineering and construction. So towards the FID early next year, we will be ready for it. Thank you.
Yeah, and so perhaps I can just, we're going to be looking at used cooking oils and animal fats and other produce. We're looking at Asia, we're looking at Americas, Latin America, Europe. So we have a global sourcing effort on at the moment to make sure that I think certainly 75% or so, I think, Carlos, we're going to want to have some kind of long-term agreements in place ready for the FID moment. And the 50 million EBITDA, I think, you mentioned, that really is calculating where we assume these feedstock costs are going to be and where we think the renewable fuel we place, taking into account the RED II multiplier that will enjoy the market.
Next question comes from Sasikanth Chilukuru from Morgan Stanley. Sasi, good to see you. We are all ears.
Hi. Thanks for taking my question. I had two related ones, please. The first one was, you've kind of highlighted that there's no material contribution from Mozambique Rovuma LNG in your capex forecast or capex guidance. I was just wondering, is that a view that's kind of shared by the other partners as well? Or in case this project does come back onto the drawing board during 2021, before 2025, I was just wondering does that mean there's upside risks to the capex, or is it something to do with your asset rotation as well? Would you be looking to exit Mozambique Rovuma LNG, for example?
Okay, Sasi, can I just take that? So, I think it's very, for us to actually give you a date of when this project will FID, will almost presume we understand how the world will develop and how the social scene there will develop. And, we really regret the loss of life that happened in Palma just a couple of months ago. And, I think the Mozambique government is working hard to restore stability there. And, I think we're hopeful that, the situation will stabilize. We haven't put capital in the 5-year plan for that. That doesn't mean to say we don't think the project will go forward. There is a scenario where we go forward with the project, and because Torre is under some pretty strict guidance on net capex, if he wants to do that, he may need to find how he can release some capital elsewhere in order to afford that. So, this is very much us saying it is premature for us to declare a date. We have a clear amount of capex we're allocating to our upstream, so 40% of the 0.8 to 1 billion. And, then Torre is going to have to manage all his portfolio to make the numbers work. So, too early to say this is going to be divested, too early to say when it's going to FID, but the discipline will stay in place.
And I will take the chance to read one of the questions that we received from the platform, from Richard from BC, Canada. And he seems to be concerned about the dividend policy uncertainty as the cost of capital would be increased due to the variability. Why buybacks were not being considered?
So, Felipe, this is yours.
Richard, I'm not so certain it's going to be that variable. If you set a dividend policy based on free cash flow, suppose you get all the volatility that comes from volatile capex, CFFO as the anchor is actually quite stable, even if you have big variations in, say, Brent prices. Brent prices collapses, you release a ton of working capital, that's within CFFO. So you do have quite high visibility on something that is designed to be variable in the first instance. So 50 cents baseline, the 20% that is supposed to be variable is actually not that variable itself. So I would reinstate that the base dividend withstands very low macro conditions, everything that comes on top, and we're assuming 60. If it's more than $60, then dividends could be quite meaningful. And you know just as much as we do, because it's a very simple 1 times net debt to EBITDA, all is distributed to you with a cap of 1/3. In the plan, we hit the cap all the time because we do have our very strong balance sheet throughout the entire period.
On the share buybacks.
On the share buybacks. So if you look back at the last, say, decades, a lot of the buybacks have really been to neutralize scrip dividends. Now, we pay good old cash dividends. We generate cash, we distribute cash when we can. The concern of using the buybacks as a top-up to a base dividend, because it's true that you can be more volatile if you do buybacks when you can afford it. We've kind of replicated this with the cash variable dividend. So it's not that different. There are no scrip dividends to neutralize, so hence 100% in cash.
Okay, and we'll come back now to the video platform. Now we'll have Pedro Alves from CaixaBank BPI. Pedro, please go ahead.
Hi, everyone. Thank you very much for the event. So I have here one question regarding your guidance for the new industrial and energy management division. We see here a big jump in EBITDA from the first years of around 200 million euros to 400 million euros in 2025. And I'm sorry if I'm missing something, but I'm struggling to reach these levels only by incorporating the refining margin of $4 per barrel and the $1.7 of OPEX. And obviously the contribution from advanced biofuels and 120 million euros of energy management. So could you please clarify the bridge to get these 400 million? And then my second question regards to renewables. I think you mentioned partnerships to expand the business. So do you consider eventually M&A to reach the 12 gigawatt target by the end of the decade? And if not, if you don't plan M&A, can you give us more visibility on the status of the pipeline of greenfield opportunities to reach those 12 gigawatts target? Thank you.
Thank you, Pedro. On the first question, I'm going to ask Felipe to make the bridge and talk about some of the one-offs that we're experiencing at the moment.
Yeah, Pedro, it's really the 400 is a lot more normal than the starting point. So I'm not certain the market appreciates how bad this has been, both with our gas trading and the hit we got with regasification costs, and how bad refining has been. So we start with a very low base. So if you normalize refining margins closer to $4 per barrel, add the efficiencies we're building, add the new units, and a very significant investment in energy management across all products. That's power as well, gas and oil, of course. So we get to that sort of number. So the base effect is what is driving your question.
Yeah, I think, and particularly this year, we've had the regasification costs have been, as you mentioned, Philippe, it's quite a big one-off hit. We hope to not have that going forward. But yeah, if you look at energy management and the HVO unit alone, that gives you more than 170. So that's a big, contribution to that future. And the second question was around. Help me. Oh, the renewables partnerships M&A. And I'm going to ask Susanna to perhaps give a little bit of color about how much we're looking at. Obviously nothing firm yet, but at the moment we will continue to look whether there are any attractive renewable platforms for us to acquire. We haven't any firm plans at the moment. At the moment, our focus is on organic growth. And why? Because we think we get a higher return from that. Because the platforms are quite highly priced at the moment. Because obviously renewables is in the vogue at the moment. So we think we get a better return from our own capabilities, going in very early in the piece into a development with a developer, and then taking it over and developing it. So Susanna, perhaps give a bit of color of how, because we look at a lot of these options all the time at the ExCom.
Definitely. I think, as Andy said, we may do selective M&A opportunities, but it will be very rarely. We still believe with the growth there is in the market, there is a lot of opportunities for greenfield or maybe early stage development. So it doesn't have to be pure greenfield. So just for example, you know that we acquired 2 gigas from the ACS group last year. But on top of that, we have added another 900 to the portfolio, and that adds to the 3.8 that you saw. But only this week we have closed already. We have executed some contracts for another 200, close to 200 megas, not exactly 200, and we expect to close another 500 in the next month or two. On top of that, we have a pipeline of at least 2 gigas of projects that we are looking at outside Iberia. So we feel very confident about being able to develop our pipeline through greenfield or mostly, as I mentioned, early development projects. And maybe in some markets, we may choose some M&A opportunities, but we are more cherry-picking good projects than just trying to make massive acquisitions for the future. And we feel confident with the team we have and the capabilities we have and the ones we are building. We are, I will say, at this point, at the end of the year, we will be ahead of our targets.
So, yeah, I think Susanna is very much keen to go even faster than we're revealing today in the Capital Markets Day. And look, I have to say, never say never. We will continue to screen opportunities for inorganic acquisitions as well. But it's not part of our core base plan in the short term anyway.
Okay, I will take the chance to read one of the questions made into the platform. It's basically related with Bacalhau Norte. The question is actually asking, when should we take FID on Bacalhau Norte? How do you think about the possibilities to monetize the associated gas in there? Any production from it included in the 25% production growth by 2025? Should we clarify?
So, I think, Tore, is Bacalhau Norte in our plans? Is it going to be producing gas or not? What can we say?
Good questions. First, it is not in our plan. We have not included any contribution to Bacalhau Norte by 2025. How we're going to handle the gas in the second phase is still to be discussed. As you know, in the first phase, all the gas of Bacalhau is being re-injected into the reservoir. And as part of the appraisal plan that we're now going to go through, we will also then decide what would be then the optimal development concept for Bacalhau Norte. So nothing included now. That's an upside for the period beyond 2025.
Good, thank you.
And we'll come back to the video questions. We have now Alejandro de Michelis from Now Securities. Alejandro.
Yes, good afternoon, and thank you very much for the presentation. Couple of questions, if I may. If I start as a follow-up on renewables, please. I think it has been mentioned the importance of having an integration between the commercial and the power generation part. And the question is, as you go abroad, can you see a situation where you start internationalizing the commercial business so you can extract even higher returns for that business? And then the second question, moving on the upstream and cash flows. Brazil is due to auction some of the fields of the pre-salt fields again later this year. How should we think about your position in those fields and those auctions, please?
Okay, thank you, Alejandro. And yeah, firstly, renewables integration down the value chain in overseas locations. Saying that we're going to build a commercial position, I think will be a bit of a stretch. Saying that we will have energy management capabilities to place the renewable energy for value and to understand how we can bundle our offerings to customers is something that we will look at. But as I said, we're also looking at quite a heavy weight to long-term PPAs in some of our overseas businesses. But as we get more confidence in that market, we may evolve that strategy. But the first plan is the long-term PPAs. But we're going to have, as I talked about, reinforcing our energy management capabilities in Galp. Doesn't just mean in Iberia, it means internationally. So that will open up opportunities. Let's go to the transfer of rights. And as you might imagine, we have now, seen transfer rights, Atapu, Sepia, we're in them. We have some unique experience on Sepia also. Are we interested? Well, I'm going to come back to Tore and say, well, Tore, are you interested? You've got a net capex you have to stay within. So tell us, what do we think about this TOR bid round? Are we interested? Are you going to have enough money to do anything there or not?
And the money, that depends on you, actually. But, no, kidding aside, Brazil is a really key country for us. And we are continuously examining all business opportunities. And If we see that we can find something that is really value creating, that is adding value to that already very competitive portfolio we have, with there's a development break even now at $25 per barrel at MPV 10. Yes, certainly we will then present it. But we have also then taken on the big challenge that Andy has given us, namely that we need to keep in within the CapEx framework we have, i.e. we have to find also ways for how we can finance it. And so we are doing both. We are on the one hand really looking into it. There is more information to come from Brazil by June with respect to the details. And then we will also look into how can we finance that in a smart and creative way. Thanks.
Yeah, so, I think with the TOR round, we've seen some of the bonus numbers significantly down from the last round, which obviously gets people like Torre quite excited, but he also knows the rules of this game on capital discipline. So we'll have to see if we can make anything work there.
Great. We are getting close to the end, not before we go to Edinburgh. And Jason Kinney from Santander. Jason, good to see you. I hope next time you also have a Portuguese flag behind you.
Yeah, good afternoon, everyone, and thanks for the refreshing outlook and the re-energized strategy. I really like it. Going back to the upstream, the new development sanction 21 to 25, NPV $25 a barrel. You've highlighted Bacalhau as a most attractive project with an NPV $35 a barrel. So I'm just wondering if you can remind us of the range of break-evens for some of the other projects that you are sanctioning in 2021 to 2025 to give us the average of 25. And I realise that there's a number of smaller projects within assets you're already developing, but if you could just go over some of that, that would be great. Secondly, on green hydrogen, is there a specific or formal role for Galp in the MOU between Portugal and the Netherlands to supply green hydrogen by 2025, I think it is? And how much of the conversion of Sines will need EU grant funding, and what kind of level of funding would you see by 2025 or 2030 for that support of that project? Thanks.
Thank you, Jason. And let's address this, the below 35. I think we said well below 35 for Bacalhau. And what else are we doing? Well, we're doing a lot of infill drilling, which is pretty low break-even price. So, Torre may say some things, but it's a combination of where we think Bacalhau sits, where we have the other opportunities we have, in particularly these very attractive infill opportunities in places like Tupi. We'll give a blended that is in around 25. Anything more to add to that? No,
the only thing that I will add is perhaps also factor in Sepia into that equation, which is a very attractive, field that will come in production in the third quarter this year. So that is the add-on. And then I think I would just underline what Andy said, namely well below 35. And I'll leave it by that.
You're going to get into trouble, Torre. All right, green hydrogen. Yeah, indeed. So, I think, I can formally say that we're actually stepping out of H2 Sines, of the consortium that was planning to deliver this liquefied hydrogen to the Netherlands. We did that a little bit because we want to actually go fast. We're going to crack on. The main customer for green hydrogen isn't the Netherlands, it's Sines. It's our own grey hydrogen position. So that needed for us to be our focus, is to start moving on that. It doesn't mean to say that as we get into this, as part of the Portuguese national plan, there is a plan to build up hydrogen. And as I say, we've got the low-cost renewable energy. We believe with a skilled workforce here, competitive workforce, we can build relatively cost effectively. But the third thing is this whole incentives and how many of the EU funds do we need and which ones. This is obviously something it's too early for us to pick where and how. But there is a combination of attracting some of the funds that the EU is offering in this area, but also the regulation around how hydrogen fuels are treated in the market. All I can say is that the will of the government, the will of Galp to actually move fast, I think is going to come and give a good conclusion here. And I think the H2C and its consortium is going to continue to explore the opportunity of making the hydrogen for the Netherlands. But our focus is going to be firstly on what we need, secondly on further industrialization of Cienisch itself with e-fuels, with gas into the hydrogen into the gas grid, with hydrogen sold to heavy-duty transport, and perhaps ammonia, and these other products, I think, for us are more obvious and immediate, and we believe economic, and that should be where Galp is focusing today.
And we come to the end of the Q&A.
So is that the end of the Q&A?
It is, Andy.
Well, look, can I just say to all of you, thank you for your patience. It's been a long presentation and a long Q&A. I hope you can appreciate that we believe Galp has a very distinctive investment case, an investment case of growth in renewables, of growth in upstream. We hope you also understand that we believe we're decarbonising, and we're giving you some of the metrics, faster than some of our peers. We are going to keep financial discipline. I hope you got that message in terms of our capital discipline, in terms of our balance sheet, in terms of being able, therefore, to distribute competitively and to offer the shareholders the upsides when the macro allows. I think it's an exciting plan. The team here is also excited to deliver that. So I've just got one message to you. Let's regenerate the future together. Thank you.